Okay, I'm going to go over a few of these exercises basically out of your homework site. So we have this company purchased some major pieces of equipment for 54 million, and they used straight line depreciation for their financial statements, and they deducted 100% of the equipment's cost the year that they purchased it, so in 2021. At December 31st, 2023, the book value of the equipment is 45 million. At December 31st of 2024, then following year, the book value is 42 million. And then there's no other temporary differences or permanent differences, and their pre-tax accounting income is 92 million. So prepare the appropriate journal entry to record the 2024 income taxes. Assume that the rate is 20%. So again, if we go back up to the 54 million that they purchased it for, and it's going to be depreciated straight line for the number of years. I guess they don't give us. Let's see if we go from the book value at 2023 is 45 million, and at 2024, or sorry, yeah, 45 million, it goes down to 42 million. So then it's $3 million a year is what we're depreciating. So that is our straight line depreciation is $3 million a year. So then that $3 million, we're going to have deducted it out of our accounting income. So that is going to be our deferred tax liability. So if we take the 3 million times 20%, that gives us the 0.6. So that has to come out of the deferred tax liability because, again, it would have been set up in 2021. Then if you look at your income tax payable, well, they're going to owe the taxes based on their 92 million plus the 3 million. Again, because that was their accounting income after they deducted the depreciation. So 95 times 0.2 gives us that 19. So then our income tax expense is going to be the difference, what we need to make that entry balance. I'm also going to say, though, if you take the 92 million that shows as their accounting income times the 0.2, you do get that income tax expense. You get the 18.4. So again, I feel like even though they tell you that's a plug, it's also, so far it's always calculated out to be the tax expense times the accounting income. Okay, then what is their net income then in 2024? So their accounting income is the 92 million. They then would deduct this income tax expense, so minus 18.4, and then that gives us the 73.6 million. Okay, so we'll go to our next question. So then this one's going to have a deferred tax asset. So we have this lawn services company reports warranty expense by estimating the amount that will eventually be paid to satisfy those warranties. So for tax purposes, that expense cannot be deducted until the warranty work is actually completed. So at December 31st of 2024, they have a warranty liability of 2 million, and they have taxable income of 95 million. At 2023, they had a deferred tax asset of 443,000 that related to this difference in reporting the warranties. And again, it's only a temporary difference. So then the tax rate for them is 25%. So our income tax payable is going to be based on the taxable income of the 95 million plus, or actually minus, right? Because now we actually did the work for the tax purposes. So why am I struggling though to find the amount of the work? So the warranty liability was 2 million, but then they don't tell me the difference. Let's go down here real quick. So the 2 million times the 25%, oh, so that's what I guess they're getting at. We got to figure it out. So the 2 million times the 25%, our deferred tax asset when we very first incurred that warranty liability is going to be the 2 million times the 25%, so that's $500,000. Then now it's down to 443,000. So then we have a change of 57,000 in that deferred tax asset. And then our income tax expense is going to be the difference between those two. And then let's see if this one also though would work. So I don't think they give me so I think that has to be this one. In this case, it has to be a plug because they don't give us the pre-accounting income. If they give us that the accounting income before any adjustments, then we can calculate it. But in this case, they do not. So then we do have to have it just be as a plug number. I guess that's all they got in this one. There's no part 2. Okay. All right, then we have our net operating loss carry forward. So we have the Baginski Steel Corporation reported a net operating loss of $400,000. And the enacted tax rate is 25%. So that's $100,000 if we multiply that out. So prepare that journal entry to recognize the income tax benefit of the net operating loss. So we're going to set up a deferred tax asset because we're going to carry it forward. So we're not going back and adjusting any prior income or prior tax returns. So we'll use it in the future. So when we use it in the future, that becomes a deferred tax asset, again, for the $400,000 loss times 25%. And then we'll reduce our income tax expense. Then it asks, well, what is your overall net loss then after you factor in your income tax benefit? So we had a $400,000 loss. We saved $100,000 in future taxes. So then our net loss is the $300,000. Then the next one is, well, what if we carry it back? So then now we have this wind farms reported a net operating loss of $132,000 for 2024. The enacted tax rate is 25%, so 132,000 times the 25% gives me $33,000 that we can save in our taxes, or that will become in this case, I can't even speak, a receivable, because again, it won't be a deferred tax asset because we're not using it in the future. It's a receivable. So prepare the journal entry to recognize the income tax benefit. So again, we're going to debit the receivable for that $36,000, and we're going to credit our income tax expense. And then the table, we don't necessarily have to apply it, but we can see that they have the income to offset that $132,000. They could offset it in the what year are we in those current years. Okay, then what is our net loss after we take that adjustment? So then again, we had $132,000 as a loss. We ended up saving $36,000 of previous taxes that we paid. So that reduces our net loss down to the $96,000. So hopefully that kind of gives you a little example of each one of them. So the deferred tax liability, the deferred tax asset, our net operating loss if we carry it forward, and then our net operating loss if we carry it back. So granted, we didn't get into anything too complex in those exercises, but hopefully that at least kind of just shows you kind of how you map it out and how you do the journal entries.